Hey everybody, thanks for joining me. We are going to talk all about SoFi's Q4 earnings. I am really curious too as to why the stock is down after earnings. We're going to dive into the numbers, see what we can figure out. Before we do, please take a minute and check out fool.com/Frankel, the link you see on your screen. Get a message right now from my sponsor, The Motley Fool. You get the top 10 stocks to buy right now. It is the best way to support this work we're doing on YouTube. Again, fool.com/Frankel. All right, so let's dive right in. You can see right here, this is just kind of the highlight slide on SoFi's earnings report. And in the full year numbers look great, Q4 numbers look great. All of this was better than expected. 26% year over year growth in revenue for the year, highest adjusted EBITDA yet. This was their first full year of profitability, and it came in above expectations. Really, really strong numbers here. Tangible book value grew by over $1.3 billion for the year. They finished the year with over 10 million members, a pretty key milestone. Almost 15 million financial products. That was 32% growth year over year. Record high loan originations. They now have over $25 billion in deposits in their banking platform. Really impressive traction throughout the business. And when we go through all these numbers, we're going to go through it, some of the key points. It's going to seem like the stock should be higher after earnings. There's a good reason why it's not, and we'll get to that in just a minute. But if you look here, members and products, right here, up 34% year over year, and you can see the percentage is declining over time, which is to be expected. But the actual numbers of new members being added, 2024 was the highest ever, over 2.8 million new members. Really impressive stats right there. Same with the number of products. They added 4.1 million products. That was by far the highest ever. Really impressive marketing funnel, I guess you would call it right here. So this ratio right here is important for one big reason. The more people that have financial products with SoFi, which are, a bank account, investment account, credit cards, that's the light blue right here. The more people that have those, the more of a natural marketing funnel it creates for its lending products, personal loans, student loans, and home loans for now. And that's the small bar right here. So the more people that are in this light blue bar, the more people they can naturally cross-sell products to and don't need to, pay advertising costs, pay high customer acquisition costs, things like that, referral bonuses, which SoFi is notorious for doing. So that's a really important development right here, and that continues to expand over time. The Galileo tech platform is another big one. And impressively, that not only accelerated from 2023 to 2024, going from 145 million to 168 million accounts that use the platform. They had some pretty impressive acquisitions as well. The U.S. Treasury recently announced that SoFi is going to be powering its Direct Express platform that is millions of accounts. They signed an agreement with another, quote, major financial services company that has not been named yet, but is going to be a top 10 customer for Galileo. So that part of the business is kind of firing on all cylinders as well. And if we look here, the lending platform, in my opinion, SoFi stock has doubled, more than doubled over the past 6 months. And in my opinion, it was this lending platform that really did it. They've seen a lot of outside investor interest. They've had some agreements to securitize loans, meaning that third-party investors are buying their loans from their balance sheet. Most people don't realize it, but SoFi has all of its personal loans, for the most part, marked as loans available for sale on its balance sheet. So, big traction there. And it got a $2 billion commitment from a third party to originate loans through SoFi's platform on behalf of third parties. And the idea is that these things create a stream of asset light fee income that can really power the platform higher without a whole lot more capital investment. No need to keep too much excess capital like a lot of banks do on the balance sheet if you're doing things on a third party basis. So really impressive traction in the lending platform. Moving on. Excuse me. Credit quality. The top line is SoFi's loans that were originated in 2017. This is defaults over time, charge-offs actually over time. And if you see the bottom line, that is what was originated from the end of 2022 to the beginning of 2024, how they're performing so far. And you can see as SoFi gets better at lending and does a better job of third-party referrals and things like that, the loans that they're actually making are doing better. So credit quality is improving significantly. Just a few other things. This is just the profitability metrics. Revenue jumped 26% year over year. I mentioned first full year of adjusted EPS profitability. This is a pretty impressive, pretty impressive traction. Not all companies that went public in 2021 and were growing at, 63% rates at the time are profitable today. A lot of them went away. So SoFi's actually been a really impressive growth story. And one kind of key thing is that SoFi really outperformed its guidance. You can see on the right here, this is the original guidance range SoFi gave at the beginning of 2024. And this is going to be significant. And I'll tell you why in a second. So SoFi estimated revenue of a little less than $2.4 billion at the midpoint of this guidance range. It got $2.6 billion. It estimated between $580 to $590 million of adjusted EBITDA. It got $666 million, way above that range. For adjusted net income, it almost doubled or more than doubled actually, its original guidance range. Same thing for earnings per share. It estimated it would add $300 to $500 million of tangible book value for the year. It almost got 1.4 billion. So SoFi has a history of making projections and handily beating them. So here's the reason why the stock is down. We'll finally get to that part. It's really a guidance issue. Now, on the top line, this revenue guidance was actually more than analysts had been looking for. They were looking for around $3 billion. So revenue guidance looks great. It's profitability guidance, their diluted earnings per share right here. They're looking for a range of 25 cents to 27 cents per share for the full year 2025. Analysts were looking for more than that. And the combination of higher revenue than expected and lower earnings than expected is a real recipe for disappointing profit margins. Now, as mentioned on that previous slide, SoFi clearly shattered expectations, its own expectations, in 2024. So take these projections in 2025 with a grain of salt. But this is why the stock is down. And if you just compare it, like I mentioned in 2024, SoFi created almost $1.4 billion of tangible book value. It's estimating way less than half of that in 2025. So not hard to see why investors might be a little disappointed in the results or in the guidance especially. So let me just go through some of kind of my takeaways and my key points and kind of my general opinion on the stock right now. So 2024 was a fantastic year for SoFi. Growth of the lending platform, as I mentioned, was, in my opinion, the biggest catalyst to the stock price and why it's up so much, and is the most important thing to watch for at least the next couple of years. The membership growth rate slowed in terms of a percentage, but that 2.8 million new member additions, that's the most ever. So not worried about that at all. A couple of new developments that they mentioned in their earnings report. I already mentioned this one. They said that they had signed a large US-based financial services provider to its Galileo tech platform. The full transition of that isn't expected until 2026, but it's a big customer. Another really interesting development, I've said before that I think credit cards are a big underutilized growth opportunity by SoFi. The company announced that it has signed an agreement with a leading hotel rewards brand to launch a co-branded card. It's unclear if that's going to be a debit or credit card, but it's supposed to launch in the first half of this year. It may be a debit card, just knowing how the Galileo platform works. But that could be a really interesting thing to watch and really boost transaction volumes. So looking ahead, the stock is plunging because revenue was better than expected, guidance was worse than expected. But a lot of potential for new products. I mentioned that the co-branded card business, big potential there. The lending platform still has a lot of room to grow. Um, I believe the 2025 guidance estimates they're made with conservative estimates. Not only could SoFi beat them, but the assumptions they're using, like 1.5 Federal Reserve rate cuts for the year, it's a conservative way to think about it. And the Trump administration could be a major tailwind for the business that isn't being factored into estimates right now. So keep those things in mind. Take the stock price performance with a big grain of salt, and hopefully you enjoyed that. Leave me any questions. I'll do my best to answer them individually. I want to thank The Motley Fool for sponsoring this video. The Motley Fool is a company that provides investing insight and stock recommendations for investors of all skill sets and risk levels. You all know how much I love researching new stocks and trying to find the next best investments. So I'm proud to partner with The Motley Fool to bring you 10 stock picks from their popular product, Stock Advisor. Stock Advisor has beaten the market more than 5 times. Go to fool.com/Frankel to get your 10 stock picks now. The Motley Fool Stock Advisor returns are 914% as of January 7th, 2025, and are measured against the S&P 500 returns of 174% as of January 7th, 2025.